good morning, everyone.
Good morning.
Hello, Mr. Kelly.
Not playing favorites. It's just I see Vinny up there right on top of my screen. That's probably a cocktail in his hand. It is an
They
hour.
can be jealous. It's okay.
We are just letting people in as we speak. Looks like there's two more in the waiting room. And we'll get started. I would guess we'll probably talk about 30 minutes to an hour today. And I just wanted to give everybody a little insight on the mortgage industry. Lots happening right now with rates dropping, and that's going to have a big effect on real estate. So I thought the timing here was good. And realtors are very similar to loan originators and mortgage professionals. They usually trend in about a minute or two after the start. So we'll just give it a moment here. And that's not a diss on mortgage or realtors. It's just we're busy. We have a lot going on, and sometimes we're fighting to clear a loan for closing or get something done before we can hit join. But looks like we have 21 and growing right now. That's wonderful. I will just give it one more minute and we will get started. I see some familiar names on here. I'm excited for this. All right, just give it another minute or so. I'll show you, I'm in, and we'll talk a little bit about this later in the call, but I'm in our content studio down here in Austin, Texas. And there's Jared getting some content. Why wouldn't you? Content is king. And we do a lot of filming down here in this studio, and I'm in Austin, Texas. So I figured I would use the podcast studio for that today. I'm going to be okay. I'm fully charged. All right, well, let's get started. Good morning, everybody. Happy Monday. Can you believe it? Q1 is almost wrapped up as we venture into the second quarter of 2023. It's been kind of a wild ride, to say the least, over the last year for mortgages and for real estate. And I'm sure we're all ready to get into Q2, and hopefully some of that pent up demand just goes breaking through the dam and we all get super busy and focus on selling a lot of homes and closing a lot of loans in Q2. I will tell you, this first quarter has gone a little faster than others in the past. And going into April, pretty excited though. I'm pretty excited to get that moving. On today's call, I wanted to talk a little bit about bank failures, what that's doing for mortgage interest rates, pent-up demand, what we're expecting there. I want to talk a little bit about marketing and making sure that you have some quick tips or tricks maybe that you could be using to get your brand and to get your name out there a little bit more. And also maybe wrap up with a little bit of Q&A, which I love to do with you all. But first of all, for those that don't know me, my name is Ryan Kelley, and I am the founder of a wonderful company called The Home Loan Expert. I've been in the mortgage industry for about 20 years. And prior to being in the mortgage industry, I was a real estate agent. So in my early 20s, barely old enough to walk into a bar, I made the decision to get into real estate. And I worked for this other company. Coldwell Banker, doesn't matter. This was 2 decades ago, so I don't know if that matters. But I went to work for a Coldwell Banker out of St. Louis, Missouri, and didn't really know much about real estate other than go in there and try to take calls and work phone duty, because we had to do all that back then, and show houses and sell houses. My first year at Coldwell, I took Rookie of the Year, and that was a lot of hard work. I'm knocking on doors, getting people interested in buying or selling. There was no marketing budget, of course, so a lot of hard work. Second year, I really perfected my dual agency strategy. I'd get the listing and then I'd go find buyers for it. And then on my third year, I made the move into the mortgage side of things, took those trophies and those awards from my real estate career and started in mortgages. I think that gives me a leg up on my competition, for lack of better words, because I do know how hard realtors work. I do know the business. I know how it works and how it runs. And even though that was 20 years or so ago, it was great because that's where I started as a real estate agent. And I feel like that's changed my whole stream past that, because I know what realtors are going through to get these deals to the closing table and how much work it goes into. And if I wouldn't have had that experience early on as a real estate agent, I think I would have probably been more of a, oh, the realtors don't know what's going on. It's always the realtor's fault type of person that we hear so much about. But starting in the real estate side of it really has given me a leg up on the competition because I know how hard you all work every single day. But for 20 years or so, the last 19 to 20, it's been the mortgage side of it. It's been helping people achieve the dream of home ownership. It's been helping folks refinance when the time's right to a lower rate and maybe even to pull out some cash when equity's high. And worked very hard my last 2 decades in the mortgage side of the business. In 2009, during the Great Recession, I broke away from the company I'd started with and started building the dream of the home loan expert. And if anybody has been in the industry long enough to remember what 2008, 2009 looked like, it was tough. You know, it was really tough. Home values were just dropping and stock portfolios were dropping. And I mean, it was the Great Recession. Everything was dropping. And, but as tough as that was to start building Home Loan Expert, it made us really tough, you know, starting off in those early years. In 2015, I got rid of my partner and launched the Home Loan Expert as a mortgage banker all by myself, my wife and I. So for the last 8 years, we've had the Home Loan Expert LLC as a mortgage banking operation. And I lead that company through the daily everything. I work with all departments, closing, underwriting, sales. You can imagine I'm pretty hands-on everywhere. About 4 years ago, I had that opportunity to sit down with Kenny and Stacy at their Gulch office, Kell's Gulch office down there in Nashville, and start the conversations about us becoming the preferred lender for Exit Southeast. And I was really humbled for that opportunity. We had both kind of heard of each other and known each other from all the business we do in the Nashville market. I'm on the radio waves there and was sponsoring the Titans at the time. So they had heard of me and I had been watching their success and their growth in Nashville. So when that opportunity came for us to sit down and start those conversations, I was super humbled by it and really excited. And we finalized that deal 4 years ago, and they gave me that opportunity to work with their Exit Southeast family. And everybody welcomed me like I just overwhelmingly, I don't know how to put words to it. I work with a lot of real estate companies. I work with a lot of realtors all across the country, but there's nothing like Exit. And that was shown day one when we announced the big partnership and the launch, and then traveling around the country and meeting so many of the agents, the owners, the brokers, admin, everybody in the Exit family. People started mailing me gifts. I got teal paper clips. I've got so much teal. It's maybe not my wife's favorite color, all this stuff coming in the door, but she's definitely warmed up to it and I sure love it. But huge thank you to everybody at Exit Realty, specifically Exit Southeast, for welcoming us into their family and giving us the opportunity to work with y'all and help you with home loans. We do have offices outside of the Southeast, but the majority of the agents, owners, and brokers that I do work with are in that Tennessee, Kentucky, Georgia, Florida, Texas market. But we do have Georgia, Denver, and a few others that we're able to help. But that region, Kenny and Stacy's, is just unbelievable. At the rally just 2 weeks ago, if you weren't able to make it, you missed another incredible event. But the good news is I bet they do another one next year. And so you'll have that extra, another opportunity. But while I was there and opted not to take a spot for speaking because I was also there with my family and we're kind of combining a spring break for the kids with the Exit Rally in Orlando. What better place to do that? I said, why don't I host a quick webinar and just give all the agents and everybody that wants to join it a little inside baseball on what it looks like on our side of the aisle, what's behind the curtain, what we're expecting and what we're seeing right now in the mortgage industry. And I thought as an agent that could really help y'all out, just knowing what we're seeing and what we're forecasting and anticipate on coming, hopefully, in the next few weeks, maybe months. Let's start right there. Go back maybe about a year ago. Heck, let's go back to January of 22 for a moment. We as lenders felt a slowdown coming before realtors did because we stopped the refinances. Those stopped on us probably getting into January of last year. We went in, if you think about last year, we went in with rates in the 3s and came out in the 7s, so that's a lot to take, and that really froze the housing market, not completely, but it definitely locked it out quite a bit. And again, we started feeling it more in January. with the refinancing starting to taper off after a wild ride the 2 years or so beforehand. And I remember talking with several people in the real estate market in Q1 of last year, like, how are you holding up? I'm like, what are you talking about? It's great, blah, blah, blah. And I'm like, we're not doing as good as y'all. But looking back, we can identify it's because we are losing the refinances before the purchase market slowed a little bit last year. So Q1, we started feeling it in lending. And then I think by Q2, the real estate side started feeling it as rates continue to go up. We got very creative in the studio last year, and we created the Marry the House, Date the Rate campaign. And we started doing things to keep it going and talking about the differences in prices and offers. And now it's better now. There aren't 50 offers coming in day one. And, did as much as we could to keep that consumer actively engaged and wanting to buy a home. And as we got into Q3 and Q4, it got a little tougher though, because rates continued to climb and we started hitting that 7% rate mark. And that's tough. It's tough for a consumer to want to go out and buy a home when all they've heard for 10 years is nothing above 4, and now they're hearing rates in the 7s, right? And they're looking at what their payments are going to be. They're going to, have harder time qualifying some of these borrowers when a rate's in the 7 versus the 3s. And you all know this. But as we got it later in the year, it became evident that the housing was also cooling. And that's when we really felt it in the lending, because the refis had stopped and the purchases had begun to slow. And rates continued to go up. And there wasn't a lot of help there coming in the form of there was no first-time homebuyer tax credit coming. There was quantitative easing had stopped. We were just kind of left out there to see what happened. As we got into this year in 23, rates were still high. They weren't showing much sign, but we were all very hopeful. Now, in recent weeks, as I'm sure you all have heard by now, we've had multiple banks fail. I'll call it what I think it is, bank failures. It started with the big famous one out there in Silicon Valley Bank. And I believe they were just sold last night in the middle of the night for a fraction of what they were worth just a month or so ago. But over the last couple of weeks, you've seen, I guess, 6 or 7 of these bank failures. A lot of them are getting rescues, some backstopping and some purchases of these assets. But when that started happening, mortgage rates started dropping. And in the last few weeks, we've had a significant drop in mortgage rates. In fact, in just last Wednesday, Thursday, Friday, we were probably down a 0.5 point as we finished off last week. So think about that decrease in rate just last week, dropping about a 0.5 point on that conventional conforming rate. Today, we're sitting at, I'm going to say, very low 6s on a conventional conforming mortgage for a 30-year fixed. Probably without any points and gimmicks and this and that, you're right around that 6.25, 6.2 mark right now. And that's good because a month ago it was in the 7s. So a month we're down about a point, and the last week we're down about a 0.5 point, and we are definitely trending to a lower rate environment. And I think what it's going to take is a rate in the 5s to really break the levee down and let all that pent up demand that has been building up for the last several months really break through. And it can't just be the mortgage lenders talking about, hey, rates are in the 5s. It needs to be kind of that nightly news or that CNN or Fox or whoever it might be. The big media needs to start breaking that story when it happens. And then the consumers will start moving back to that. Let's go look at homes. Let's go get things going. We can handle that. I think that overall consumers can handle mortgage rates in the 5s. And I don't think that matters if it's a 5.1 or a 5.875. They just need to hear from the big media, from the news source, from trusted outlets, that mortgage rates are in the 5s. And again, I don't think that matters if it's 5.2 or 5.8, just the 5s. It seems that in the current market, everybody can accept that and take that as it's time to go buy a new home. It's time to get things going. So as we trend from a 7.25 today, a month later, down to about a 6.25, and hopefully still moving that direction down, I would keep your eyes on that, because when we do break into the fives, I would expect a lot of pent up demand to come. And I think I know there's thousands, if not hundreds, there's so many people that we've talked to and pre-approved to buy a home. And that's what they're telling us. Like, we need to see something a little lower, and 5 seems to be that number. So when that does come, and it could be a week or 2 weeks, and nobody really knows that exact answer, expect you all to get very busy. Because if you've been doing a lot of work over the last several months and staying in front of all of your potential clients or your past clients and doing those things, I believe that in the next few weeks, assuming that rates continue to trend down, your phones will start ringing more than they have in quite some time. Now, some of you might be having stellar record year. That's great. I would still expect it to pick up once we see rates hit those 5s. Again, high 5s, low 5s, just give us a 5s. I think that you'll start to see people move. And purchase applications should really increase. And that's great news for both sides of the industry, your real estate side and for mortgage lending. So right now we're watching the Fed. I guess the Fed controls everything as we sit here. We're watching inflation. Consumer price index is a big number that comes out monthly. The CPI number is really moving mortgage rates as well. And it's tough to say this out loud, but more bad news for banks does give good news for mortgage rates, which gives good news for real estate market in whole. So not that we're rooting for the more banks to fail, but more bad news for banks definitely will be a big trigger to bring rates down, which again, then ultimately goes right into your wheelhouse to showings and contracts and closings. I'm not sure the status of the banking industry today, but if you read some of the things on Silicon Valley Bank, what they were purchasing with their big deposits were long-term assets. They were parking that money, specifically Silicon Valley Bank were parking that money in mortgage-backed securities, kind of a form of a bond. And there was very low interest paid on those, and those were long-term 5 to 10 year type investments. But when the Fed kept raising the Fed funding rate, and all of a sudden now you as a consumer could put your money in a bank and get 3% interest, you could just do other things. People went to the bank and said, I want my money out. I want to move it to something else. And that's what caused a lot of those problems for Silicon Valley Bank and other banks, as people were withdrawing their funds to put it into something else that was achieving a higher rate of interest. But the banks had bought a lot of these bonds, like mortgage-backed securities, as a long-term play. And that's where they got into liquidity problems. And then you had to talk about the Fed coming and backstopping them all and bailing them all out. And good or bad, won't argue that one. That showed that the Fed was also very active in keeping things moving, which we had not seen in the last year. So the mortgage industry, seeing the Fed was interested in funding things again, putting more money out in the streets, doing things, is what again now has drawn rates down, because there's some relief in sight here now. So again, not that we're rooting against the banks, but more bad news for banks equals lower mortgage rates, equals more pre-approvals, homes closing, all of that. We know we're sitting on a ton of pent-up demand. As rates continue to work their way down, we would expect to get somewhere into the 5s, or maybe we're just hopeful, but we're getting close. And then I would foresee these hundreds, if not thousands, of pre-approvals that we've been doing over the last few months to start to come back to us and say, we found a home. We're ready to go. Let's go. So it's looking good for us. And the timing of today's call might just be perfect, because a month ago, we really wouldn't have known what to say, except just hold in there and do all the things you're doing and things will change. But now we're actually starting to possibly see some of those changes come to light as we sit here today. One of the things I would say is just get prepared, because it could be sooner than later that the calls, the emails, everything comes in, and he or she that has their systems the most updated, ready to go, that can handle the volume, can handle the clients coming in, ready to look at homes, ready to make offers, they will be the one that wins. So I would be utilizing as much of this time as you can to really go through all your systems, everything that you do. Look at your software, look at how you handle calls, emails, marketing, everything you're doing, and really tighten everything up right now, because when that levee breaks, I think it will come pretty quick. I don't think it will last a long time, but you're going to see a big influx of that pent up demand. So use this time that you have now to really shore up your systems, to get prepared for that, to make sure everything is optimized and working well, that your team is ready to go, or your assistant or anybody that you might have. So when those calls do start to come, you're ready to go and you can gobble up as much of that pent up demand when it breaks through as possible. For me, that's exactly what we're doing. We're looking at every single part of our business and we're making sure that it is fine-tuned and ready to go and very optimized. We're getting our marketing machine cranked the dial even higher than we've done over the last few months, which is saying something. But we want to get that messaging out there, remind everybody that the home loan expert is here, ready to pre-approve you same day. We have a 12-day closing guarantee, all those different things. We're just getting that message out. And then of course, we're talking rates dropping as well to try to help, get those pre-approvals coming in to turn to contracts. But again, I believe it needs more than just us talking about it. It needs the mainstream, end quote, media to really start pushing that message out there to get people off, the couch, out excited, looking for homes, doing all those great things. So fine tune your systems, do as much marketing as you can, make sure you're ready for those clients. And in the meantime, this morning we started handwriting thank yous to all of our clients. And that's a process that probably never ends, but it will take a long time, and just doing whatever we can to touch potential clients, past clients, whatever it might be, through handwritten thank you notes was our theme today. And we're doing something like that every single week, sending out little gifts, writing the thank you letters, doing what we can. We're sending more emails out than we had this year, and just preparing so that we have that brand awareness out there. So when rates continue, hopefully to get to the fives, the pent up man opens, we can gobble up as much and send you as many deals as possibly in the Exit Southeast region. I wanted to open up and do a little bit of Q&A, but I'll give you kind of a blanket on mortgages as far as lending and loan programs. Regardless of what you might hear, it has not gotten tougher to get pre-approved or to get qualified for a loan. In fact, some of our government loans like FHA have gotten a little bit easier in recent weeks to get approvals on, with the lowering of mortgage insurance specifically recently by HUD to FHA. So the cost of an FHA loan and other government loans has come down in recent weeks. I can't speak for all lenders, but at the Home Loan Expert, if a loan can get done, we can generally do it. We have we are mortgage bankers, what we call on our side correspondent lenders, mortgage bankers, which means we process, underwrite, close, and fund these loans all in-house. And that gives us control of that file. So when you call and say, I need a deal, I need to close in 10 days, let's go. We're able to do that as a mortgage banker. We're able to offer a very streamlined, keeping it in the wheelhouse, expedite things, and access to great rates and all that. At the end of last year, going into this year, we also opened up a wholesale side of our business. And that would be more of what you would think of as broker side. And for years in our industry, there's always been this, what's better, banker, broker? And they both have great arguments back and forth. Wow, we're better, you're better. You don't even make your own underwriting decision. You blah, 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 blah. So there's always been this back and forth in the lending of what's better, banker, broker. And naturally, we were born as a bank and we will always be a banker. But we wanted to offer our clients even more. So at the beginning of the year, we launched a very robust wholesale side of it. That's that broker side, where we'll originate those loans, we'll process those loans, but we will not underwrite them or even close them. So we're hybrid at this point, where we are a banker and a broker. And I tell you that because that guarantees we have access to everything at this point, everything you can imagine, loan program wise, and of course, the lowest possible rate. Not only can we run it through our channel as a bank, but then we can shop it or price it for your borrowers or your buyers with United Wholesale Mortgage or with a few others, just pull some out of the sky to make sure that our rates are the lowest possible rate. And if it's a loan that's not closing for 30 days, then we don't have the risk of sending that wholesale. So let's see if we can get the rate lower by doing that. So we adapted as a company, having the banker broker hybrid program, which again gives your clients and our clients access to unlimited loan programs. So if there's a program, we can do it. And ultimately verifying that we are getting them the lowest possible rate. If it's a tricky deal, if it's a little bit more complicated to structure, or if it has to close quick, we'll keep it in-house, no questions asked. But if we have some time and it's a W-2 clean borrower, whatever that looks like, we know we can shop that out, again, just to ensure that we're getting the client the best possible loan program out there. So Govy loans look really good. As we mentioned, lower PMI, lower cost. Conventional is looking really good right now. We have down payment assistance programs in all of your states where they can buy a house with no money down. Doesn't just have to be VA or USDA, which we love doing, but we have a lot of down payment assistance programs that we've partnered up with in multiple states, if not all of them, where we can help clients even without a down payment now get into a house. I made a commitment to exit Southeast. If you have clients, if you'd like to talk about a preferred lender relationship, you'll call me now, only me, and I will handle all of those for you. So I won't just kick you over to a loan officer and wish you well. I will personally oversee and take all those transactions out of the gate. I will tell you before we get to the end and I forget, if you're interested in hearing some of the opportunities of what we can offer as a preferred lender, marketing opportunities, co-branding opportunities, whatever that might be. First one, a follow-up one, and then the link, just reply. They come straight to me and say, hey, I would like to hear about becoming your preferred lender, having you as a preferred lender. Let's set up a time to talk. And not only will I have those talks with you and kind of work out what we can help with, but then I'll also make sure that your buyers are well taken care of. I will oversee all exit Southeast and outside of the region. I will handle my team and make sure that your clients are well taken care of. And as the founder and CEO of the company, it's a big move to ensure that I do talk to each and every one of you and talk to your clients. But it's important for me to make sure we're delivering the best level of service to all of your clients that we have the opportunity to work with. That's a lot on mortgages and what our view is for pent-up demand and things coming. I talked about rates. I talked a little bit about our hybrid program. I told you that I'll be your guy. I won't just kick you off to somebody else. I do have an incredible lending team, and we're really solid in what we call the corporate team, my team. And I think you all will really love all the service, that we do provide your clients and how good we can make you look. Let's get into some Q&A. We're 30 minutes in, and I kind of just wanted to end it with that. I can take questions. I've got a couple people on the call, some of our loan originators that might be able to help me out with if I'm getting a little old and don't know the answer, but let's open up for some Q&A and talk through some great stuff. Anybody got some great questions? And I'll monitor the chat as well, but go ahead and speak up if you have some stuff. I'd love to talk to you. Always a good sign when I don't, unless I'm muted. Oh, there I am. What if I was muted this whole time and no one heard me and they're just watching me talk? Well, if we don't have anything, that's good. It's Monday morning. Get ready. We're fully anticipating rates to, maybe not every day, but over the next few weeks to continue a downward trend. And I think it's going to take a rate in the 5s, and I think that levy will bust. And I think we will all be scrambling around, showing property, moving contracts, addendums, closing tables, and all of that. We have things like automation that we're big in at Home Loan Expert. So you as the agent can log in, look at your borrower statuses, receive notifications when it goes to underwriting, appraisals come in, all those things. So you never have to call and worry. We've got a lot of stuff, just verifying which email and number. It's great. I could type it in here, RYAN at the, I'm just going to say it. My personal email, again, you can reply to any of those emails, but it's Ryan, that's RYAN at thehomeloanexpert.com is my email address. And it comes to me and I'm the only one that gets it. So you can send me any email you like. And please, if you like, now is probably that time. If you'd like to talk about preferred lender relationships, co-marketing, all of that, let's have that conversation today or this week and get ahead of that. So as things do pick up and get busier, we don't have to worry about scrambling around at that point. I can set you all up on a rate text alert. Every week I send out current rates. and that's a text message, and it goes just to your text thread. And it will show you this week, we ended with conventional conforming rates at this, Govy rates here, a couple of little things. And that way, as a realtor, you know those rates, they're active. And if you have borrowers or buyers, bring them up. So rate text marketing, I've had several exit agents out here to our Austin content studio, and we film a lot of stuff. We can do all those types of things for you. We can, there's really no limit to what we can support in the marketing or the lending side. So just reach out to me. I'd love to talk with you. And if we see a big shift in the market, I'll maybe put another call like this together in a week or two, just depending on when that timing looks like. And if rates do get into the fives, I want to be the first to tell you that, hey, 30-year fixed conventional is now in the fives. Just so you're aware, Govy loans are already in the fives. That's FHA, VA, and so forth, and 15 years. So government loans are already down in the fives, 5.6, 5.7, 15 years, about the same. And 30-year conventional conforming is in that low 6, but again, moving down. And when that 30-year, which is what most people talk about, breaks in the fives, let's all get really busy and help people achieve that dream of homeownership and remember why we got in the business and how awesome it is at that closing table when you see your buyers or sellers and how excited they are, you know, about purchasing that home. And that's why we do what we do here, is to for that relationship and just seeing that excitement in the family and then checking in. Stay on top of your clients. I'll leave it with that. Mail them handwritten thank yous, call them, text them, email them, tell them thank you, ask for referrals, whatever you might need to do. All right, I'll leave it there. I wanted to keep it about 30 minutes and we're right on time. If anybody has anything you would like to chat about, I'd love to talk marketing, mortgages, anything at all. You have my email, come straight to me and I will watch your pipeline. I'll watch your deals and take care of it. Thank you, Vinny, for the applause. Thank you, Exit Realty, all the way from the bottom to the top. I mean, there's nothing else like it out there. I mean that. And thank you all for taking the time this morning. We'll talk really soon. Bye, y'all. Let's go sell some homes.